All right, good morning everyone, and thank you very much for coming to this joint seminar between Mills and Reeve and Crowe. Hello, I'm Simon Petley. I am from Mills and Reeve, and Vicky, give us a wave.
Hi.
Here from Crowe, and we'll be giving you a couple of talks today. I'm going first, and my talk is around the recent case involving Cooper, I think is how it's investment fund foundation. This is all around members of charitable companies, fiduciary duties, what they owe, and so on and so forth. And Vicky's going to be talking about issues around going concern. So if we could, so this is the case, as I say, around CIFF, as it's known, the Children's Investment Fund Foundation. CIFF is a charitable company. It's a very substantial philanthropic charity which funds substantial projects in the third world aimed for the benefit of the welfare of children. Large scale, vast sums of money, a fabulous philanthropic charity. It's a tremendous organisation. And this company was set up in the first place by these two individuals who we can see here. So Christopher Hone and his now former wife, Jamie Cooper. There were three members of this company, those two and their friend, Dr. Mark Letimaki, who is significant in this case. So Christopher was an extremely successful hedge fund manager, and my understanding is in the earlier stages of the setting up CIFF, his hedge fund contractually gave a certain percentage of its funds, its profits every year to CIFF as a way, he said, of motivating himself to make even more money to increase the sums in the charity. And this was built up into this very substantial philanthropic charity. Now, unfortunately for the administration of the charity, and indeed, no doubt for themselves personally, so Christopher and Jamie Cooper split up and divorced, and their divorce was reported at the time as being the largest ever divorce settlement in British divorce history. From a quick look at Wikipedia, at the time, I believe Sir Chris was worth around $1.5 billion, and he was ordered to pay Ms. Cooper $550 million. According to Wikipedia, which gets its numbers from Forbes, and goodness knows how they calculate this, he may be worth around $5 billion now. Anyway, very successful and very wealthy people. Now, as part of their separation arrangements, things were obviously difficult administratively within CIFF. They were two of the 5 or so trustees, and they were 2 of the 3 members, and there were issues around deadlock and so on and so forth. So as part of the separation arrangements, they also agreed that they would each personally put $40 million into a new charity formed by Jamie Cooper called Big Win Philanthropy. Jamie Cooper also agreed that she would resign as trustee and member of CIFF in exchange for CIFF itself, the charity itself, making a payment of about $360 million to this Big Win Philanthropy, this new charity. And this was always going to be subject to approval of the payment being given by the Charity Commission or the court. And Big Win Philanthropy operates in a similar space to CIFF, has similar objects, so the funds would be used for similar philanthropic purposes. Now, because this payment was being made by CIFF in exchange for Ms. Cooper stepping down as trustee and member, this fell within the Companies Act definition as a payment for loss of office, and therefore the payment, as well as being approved by the trustees or court or so on, also had to be approved by the members of the company, even though there was some overlap. Now, the non-conflicted trustees, so the 3 or so remaining trustees, not including these 2, applied to the Commission, which approved an application being made to the court to make a decision. And all the trustees, the conflicted and the non-conflicted trustees, surrendered their discretion to the court. Now, you can always do this as trustees of private trust or charitable trust for certain decisions. You can either take a decision, but if it's momentous, you can get the court to give its approval of that decision, or in some cases you can just completely surrender your discretion to the court, which is what the trustees here did. Now, Dr. Letimaki, as a member, would then have to vote under the Companies Act to approve the payment for loss of office, and he didn't. The votes didn't come up, and he didn't make it clear how he would vote. And his evidence in the case was, well, he would study this properly using his considerable intellect and skill to work out if he thought in subjectively he thought this was in the best interest of the charity. So there's the possibility, therefore, that any order that the court might make would be stymied by Dr. Letimaki as a member, would be thwarted if he refused to approve the payment. And this obviously was a concern particularly for Ms. Cooper, but also a concern to everyone, because this payment out was a method of resolving the sort of deadlock and administrative issues at the heart of the charity following their separation. So at first instance, it was at the High Court. The High Court concluded that, yes, this payment does require a member's resolution, is what it says in the Companies Act. They said the founders themselves, these two, can't vote because of conflict of interest. They said it was in the best interests of CIFF to make the payment because it would break the deadlock, the bad blood and everything. It could even prove an existential threat to CIFF, so that resolving this, cutting the Gordian knot and making this payment would be in the charity's best interest. And at first instance, the court said, yes, we can order Dr. Letimaki to pass the resolution, because they said he held fiduciary duties to CIFF as a member, not as a trustee, as a member. Now, Dr. Letimaki appealed against that decision, saying the court can't direct him how to exercise his vote in a particular way. There's no question, he said, but he would undertake this exercise properly, in a dutiful fashion, doing everything properly. And there's no question of him being in breach of any duty, but it's not for the court to tell him how to vote. It's for him exercising that duty. So he appealed the High Court's ruling. The Court of Appeal, as with the High Court, the first instance, held, yes, the members of the company owed it fiduciary duties, but they said the court had no power to compel him to exercise his vote in favour of the resolution, because there's no evidence of a breach of duty on his part. And generally speaking, in trust law, fiduciary law, the courts will not step in to interfere with a fiduciary's exercise of discretion, a trustee's exercise, unless there's evidence of breach of that duty. It's not for the court to step in and do these things. And the Court of Appeal also had concerns that if they ordered Dr. Letimaki to vote in a particular way, that would be cutting across the intention of Parliament in what it had put in Section 217 of the Companies Act about members voting on these payments for loss of office. So this left matters in a state of some confusion. It held that members do have fiduciary duties, but they're sort of free to exercise it themselves. And fortunately for everyone, it got appealed to the Supreme Court. Now, by the time it got to the Supreme Court, I mean, it's completely common ground that the payment was in CIFF's best interest, the proposed payment out. And the court really only now had to decide whether it had power to direct Dr. Letimaki how to vote as a member of the company, which involved deciding these key points. Was he, as a member, a fiduciary? Did he have a fiduciary duty? And if he was a fiduciary, were the circumstances such that the court could intervene in the exercise of his discretion on this vote, and on what basis would they do so? So, with apologies to repeating old ground for many of you, just a quick reminder of what we mean by a fiduciary. So a fiduciary relationship arises as the result of the existence of a particular relationship between two parties, where one party agrees that it will act for the benefit of the other party, the beneficiary. So a classic fiduciary relationship is, of course, trustee and beneficiary in a private trust or a charitable trust, where the trustee has the power, has the legal ownership, can decide things, but it is for the benefit of someone else. And similarly, company directors have fiduciary duties to companies. That's been codified in the 2006 Companies Act. That's now a statutory duty, but it was always a fiduciary duty before, because they are acting on behalf of the other person, in that case, the legal person of the company. And in the law of fiduciary relationships, there's a few key propositions about how a fiduciary must act for the benefit of the beneficiary. So firstly, a fiduciary mustn't put themselves in a position where their personal interests conflict with those of the beneficiary. That's the no conflict rule. The fiduciary mustn't profit from their position at the beneficiary's expense, the no profit rule. And the fiduciary owes undivided loyalty to the beneficiary and must avoid situations where the fiduciary's duty to someone else conflicts with the fiduciary's duty to the beneficiary. So the undivided loyalty rule. So these are the three sort of classic things at the heart of any fiduciary relationship. Now, in companies, in non-charitable companies, it is abundantly clear that a member of a company owes no fiduciary duties to the company or anyone else. If you own shares in a company, you are free to exercise your votes in relation to those shares completely in accordance with your self-interest. Absolutely clear law. So it would represent a change if members of a charitable, of any sort of company, in this case a charitable company, are held to owe fiduciary duties. But that is now the position. So if we could move on. So the Supreme Court decision has answered a lot of questions, but as we will see, it's left a number unanswered. So it is clear now that members of charitable companies do owe fiduciary duties, but it's also clear, as we'll see, that the extent of those duties will depend on the particular circumstances and will have to be worked out on a case-by-case, charity-by-charity basis as these issues arise. Letimaki was a fiduciary. The most lengthy and thorough judgment was by Lady Arden, which covers most of these points. On one point, Lord Briggs and a couple of the other judges found the same answer as her, but for a different reason, which we'll come on to. But on this, it's Lady Arden's judgment is the main one. And she noted, as we've looked at just a moment ago, that she put it, the distinguishing characteristic of a fiduciary is that he owes a single-minded duty of loyalty in matters covered by his duty. And here she held that members of charitable companies owe fiduciary duties not to the company, but to the charitable purposes of the company. So, and as a member of a charitable company, you have a duty of single-minded loyalty to the charitable purposes for which that company has been set up. As with any fiduciary duty, the duty is subjective, and what member A might think is genuinely in the best interest of the charitable purposes of that company may be different from what person B might conclude in the same situation. But it is this single-minded duty. And even though these duties can be sort of tweaked downwards or restricted to some extent, you can't reduce, the court says, those members' fiduciary obligations below the irreducible core of obligations to perform the trusts honestly and in good faith for the benefit of the charity's beneficiaries. So whatever else we take from it, any member of a charitable company, and it may be a more extensive duty, but absolutely has a duty to vote as a member, perform his functions, his or her functions, honestly and in good faith for the benefit of the beneficiaries of that charity. So that is now the law. Result of this, and we'll see, it's a bit of a mishmash. The nature of these fiduciary duties owed by members, it's sort of set out in a mixture of now charity law, company law, and the particular memorandum and articles of the company in question. So it's a contract and statute-based model. It's a duty, as I say, owed to furthering the purposes of the company, not to the company itself. Trust law does allow fiduciary duties to, as she put it, be diminished by an appropriate means and to an appropriate extent. So the memorandum and articles in a particular charitable company can restrict the nature and extent of those duties, but not below that irreducible core that I mentioned. So your particular fiduciary obligations as a member of a charitable company may in fact be rather different from what one would normally expect a fiduciary obligation to look like in other fiduciary relationships. So this has to be worked out on a company by company basis. And the Supreme Court held that it could direct Dr. Letimaki in this case to vote in favour of this resolution to approve the payment for loss of office. Now, the majority, Lord Briggs, Lord Wilson and Lord Kitchin, they said this intervention by the court would be allowed because any decision by Dr. Letimaki not to vote to approve the payment that the court had already decided was in the best interest of CIFF would be a breach of duty. And the court can always step in where there's a breach of duty by a fiduciary. So in circumstances where all the trustees, who are the main sort of governing part of the company, they, with the Charity Commission approval, have surrendered their discretion to the court has decided this payment is in the best interest of the charity. It would be impossible, basically, the court said, for a member in those circumstances, however well-intentioned, to properly conclude that that payment wasn't in the interest of the charity. The court's decided that issue. Therefore, to stop any breach of duty, the court can direct him how to vote. Lady Arden disagreed in that she said, no, the court can't step in on the grounds of breach of duty. There hasn't been a breach of duty. We've not reached that stage yet. And she just said essentially this was one of those rare exceptions where the court will step in even where there's not been a breach of duty. They came to the same conclusion they could direct him to vote in favour of. And they also held that Section 217 of the Companies Act, this was one of the concerns of the Court of Appeal, didn't prohibit the court from directing the member how to vote. Now, counsel for CIFF, he put forward there a number of sort of practical issues that might then arise, some of which were answered. So some of the questions he posed were, well, can a member of a charitable company with a conflict of interest vote on a transaction? Should there be a declaration of interest by a member with an interest in transaction before a vote at a meeting? Does a member have a duty to attend and vote at meetings? What information can a member demand from the company before exercising the vote? And would a member be liable, as a trustee would, to compensate the company if he exercised his right to vote in breach of duty? So these are all good questions. Well, a number of these were answered. Lady Arden said that a member who stands to benefit from a transaction should declare the conflict and not vote on the particular transaction, even if that's permitted by the memorandum and articles, so that no conflict rule is in place. The court held that a member has no greater right to information from the company than a member of a non-charitable company would have. So you're left with the position that a member, you may have a fiduciary obligation when exercising a vote, but you may be denied key information that the trustees would have and that a normal fiduciary might have, but you might still have a duty but not have that access to the information. You've only got the normal corporate rights as a member of a company. So you might vote without the same level of knowledge that would be expected. And they've said a member can benefit personally from such a vote without offending the no profit rule for fiduciaries, where that's authorised by the articles and where, and subject to this need for disclosure of conflicts of interest and so on and so forth. They also held a member in these situations can delegate the right to vote to a proxy if the articles allow it and the Companies Act allows it. So some questions then which weren't answered, we'll come on to, does the member have a duty to attend and vote? We don't know. Can a member fetter his discretion by making a voting agreement? Ordinarily, trustees can't fetter their discretion going forward and commit to deciding things in a certain way where they've got a discretion, because what you know now is not what you'll necessarily know in the future. So not fettering yourself is something that applies to trustees, but not, we don't know whether that applies to members. Can a member be indemnified for any cost of attending meetings and taking legal advice? These are unanswered. So if we turn to the next slide, and we'll have just a very quick look at what we can expect next. There are clearly some grey areas. We know now that members have these fiduciary duties and the court has got jurisdiction to order them to vote in a particular way in appropriate circumstances. And this may be of use to trustees of your sort of organisations in the future. If you're going to make a difficult decision and you're considering to ask the court to take the decision on your behalf, but you're concerned that such a decision by the court could be blocked by a reluctant membership, well, this case is good evidence now that if a court decides something's in the interest of the charity, the membership can be overridden to that extent. So any of you who work in membership charities, you're going to have to take action, if you've not already, to address issues of disclosure of members' interests and conflicts of interest and that sort of stuff. So around the corporate governance side, there'll be things to do. And depending on the particular charity, the fact that members shouldn't vote on an issue from which they could personally benefit might raise some problems for some charities, depending on your governing documents and so on. A number of questions, as I said, in relation to the previous slide, remain unanswered. This stuff about whether you have a duty to attend and vote at meetings as a member, whether you can fetter your discretion as a member and so on. And so even with the benefit of the Supreme Court's judgment, there are a number of scenarios that can arise where unpicking the nature of a member's duties and working out how things work is going to prove particularly complex, and it's going to throw up questions without easy answers. And one question that's been posed, to which I don't know the answer, for example, if a charity is the sole corporate member of another charity, can that charity, when exercising its vote, exercise its powers which are in accordance with the interests of the parent charity, even though it's got a fiduciary duty to the charitable purposes of the subsidiary charity. So there may be situations like this which are problematic for some people. And the Supreme Court did hint that fiduciary duties of members of charitable companies may differ from the fiduciary duties of members of charitable incorporated organisations, CIOs. So if you're thinking of setting up a new charitable structure and you're promoting this, this may leave you with some uncertainty as to which route is preferable in this situation. So there's no easy answer to that. Now, at the Court's guidance, hopefully the Charity Commission will now issue some guidance on the nature of member fiduciary duties and what this means in practice. My guess is that that will probably look at mass membership charities to start with, because some of these, practical concerns, if you've got a membership of 5 or 6 members, then you can look at this in one way. If you're looking at the National Trust, say, applying these same strictures to membership of an organisation of that size would be very difficult. So, watch this space for that guidance from the Charity Commission. But if you are in these membership organisations, charitable companies with members, now is the time, I think, to start having a thorough look and refresh of your governance procedures to deal with some of the issues that arise from this case. So that was all I have to say about this question. I'm not sure whether we've got questions via the chat function. We can, if you fire off those, I'm sure we can try and answer those as we go along, or of course email me or no doubt Vicky after her talk in relation to our sessions, and we will do our very best to answer. But there you are. That was what I had to say on the CIFF case and the fiduciary duties of members of charitable companies. Thank you.
Thank you, Simon. If we don't have any questions in the chat, I'll move on to my presentation on going concern. So going concern has always been there as an issue for charities to consider, but I think the pace of change during the pandemic and the level of uncertainty has given it a whole new meaning. So if you can of what I'm going to take you through today in terms of what we're going to discuss. So just some definitions to start with, and then understanding some of the finer points, what you can do for your board, and then just a bit of a conclusion at the end. So hopefully take you through that in around 20 minutes. So I've done a couple of, 3 definitions here. So if you look at the dictionary definition of a going concern, which is a simple layman's assessment, a business that is operating and making a profit. So I think we'd all relate to that. FRS 102, which now guides UK GAAP, says that an entity is a going concern unless management either intends to liquidate the entity or cease trading, or has no realistic alternative but to do so. So there's 2 parts of that. One is intent. So we see this quite often in the academy sector. If a single academy decides that it's going to join a multi-academy trust, it ceases to be a going concern because it's decided that it as an entity is going to cease trading and it's going to transfer the school to a different legal entity. So that's an example of where the former part of that definition comes in. I think really for the rest of this presentation, we're going to be talking more about where you've got no realistic alternative but to do so. The charity SOAP, interestingly, doesn't define going concern particularly anywhere. But CC12, which is the Charity Commission's guidance on planning and managing difficulties and insolvency, describes going concern as the ability of an organisation to operate for the foreseeable future. And we'll certainly see that phrase again. I think what I'd like to do now is a short poll, if we can do the poll, please. Okay. So this is just relatively straightforward. So thinking about your charitable organisation, if you can just click where you are now. Do you think you're a going concern with no issues, a going concern with some issues, a going concern and you are worried about your ability to continue, and sort of the last one there, we have problems and may have to close. So I think we'll just give you a few more seconds to vote. Yep, shall we close that there then? So hopefully you can see on screen there that we've got most people think they are a going concern with some issues, so that's 52%. 39% going concern with no issues at all. Few that are worried, 9% there, and thankfully none with problems that we'll think we'll have to close. So if we can close the poll and move on to the next slide, please. So these are what the requirements are of trustees and the senior management team effectively in relation to going concern. So the normal default position is that accounts are prepared on a going concern basis. So that is what a charity would normally do. So the trustees have to make their own assessment of the charity's ability to continue as a going concern and assure themselves of the validity of that assumption when they're producing the accounts. So they should take account of all available information about the future, and we'll come on to this phrase a little bit more further on, for at least but not limited to 12 months from when the date the accounts are approved. So that's what the charity SOP says about how going concern should be assessed. CC12, again, that guidance on managing financial difficulties, says a trustee body should have a good knowledge and understanding of the charity and its finances, so that as far as possible, the continued viability of the charity and its charitable activities can be assured. So 12 months. 12 months is a minimum period. So at the minute, we're auditing quite a lot of independent schools, which are charities. Most of those schools will have done a budget for the 12 months to August 2021, but then they will probably be signing their accounts in December. So at December, their forecasts need to look forward to at least December 2021. So either they need to roll it forward for an extra 4 months, or they need to do a whole extra year through to August 2022, which a lot of people find easier to do at a high level rather than doing just those 4 months. So 12 months is the minimum period that you have to look forward from when the financial statements are approved. If you have known difficulties beyond that 12-month period, they cannot be ignored, often known as a cliff edge. So for example, if your main contract that allows you to operate as a charity is for 3 years, and in 18 months from when you're signing accounts, that contract is up for renewal, that's a potential cliff edge if the soundings are that you might not get the contract, that it is going to go out to a proper retender. There can be a significant risk there. So you need to have a scenario that looks at what if that contract isn't renewed, even though the renewal of that contract is beyond that 12-month horizon. There's something that you need to consider as well as whether you're a going concern is whether you have any material uncertainties around going concern. And this is what the charity says about material uncertainties or events or conditions. If they cast significant doubt on your ability to continue as a going concern, you should explain that in your accounts. So an explanation as to what those factors are and what your conclusion is, and a balanced, proportionate and clear disclosure about any uncertainties that make the going concern assumption doubtful. There is then that bottom option that you might conclude that you're not a going concern. But at the minute, what we're seeing is charities either concluding that they are a going concern or that they have a material uncertainty. So the sort of factors that would give you a material uncertainty, if you get a significant portion of your income from events, whether they be ones you've hosted yourself or people doing runs or sporting events or challenge events on your behalf, they won't have been happening very much during this lockdown period, and therefore your voluntary income will be significantly affected. We act for a number of leisure trusts that run sports facilities. They were expecting to be open at the beginning of July. They weren't allowed to open until the beginning of August, and then they closed again from the beginning of November. So whether or not they're allowed to open, the impact of that on their gym memberships and other income is something that would be a material uncertainty. Charity shops, most charity shops have had to close and reopen and then close again in a similar way to leisure trusts. Performance charities, theatres, orchestras, those types of organisations haven't really been able to open in any real sense during the pandemic at all. So again, that would be a material uncertainty. So where there are material uncertainties, you do need to disclose those and conclude on what impact it has on your charity. If you do conclude that you do have a material uncertainty, then the impact on that in terms of your auditor's report will be that they do what's called an emphasis of matter paragraph. So this isn't a qualification as such, but where the audit report talks about going concern, it cross-references to the trustees' disclosure, usually in the accounting policies section of the accounts, and draws readers' attention to those disclosures around the material uncertainty in relation to going concern. Next slide, please. Just wanted to say a little bit about insolvency. I'm sure we could spend 2 hours talking about insolvency, but I've gone for 1 slide's worth on insolvency. So in very simple terms, solvency is the ability to pay your debts as they fall due. So if you're not able to pay your debts as they fall due, then you are potentially insolvent. And there are 2 main tests around this. So one is the cash flow test. So do forecasts show that you're operating within your facilities? And then there's a net asset test. So are current assets and net current assets positive on the balance sheet? So if when you look at your stock debtors and cash and deduct your creditors due within 1 year, that's your net current assets. If that is in brackets, that's a technical insolvency. And likewise, if the net assets, i.e. your bottom balance sheet total, is negative, then that's also a technical insolvency. So a lot of charities that have defined benefit pension schemes, their pension liabilities will make their net assets negative. So if you are insolvent, then you do have to give, or technically insolvent, you do have to give greater consideration to going concern. And the cash flow test is just looking at your cash flow forecast on a monthly basis, and maybe a weekly or a daily basis if things are very tight, to make sure that you are able to continue to pay your debts as they fall due. Next slide, please. So how do you go about making a going concern assessment? So the very first thing to consider is, does the charity have access to sufficient liquidity? So effectively cash flow. Have you got enough cash to continue to trade? What usually makes an organisation get to a point where it can no longer continue is when it can't pay its payroll. So your payroll is quite relentless. There's a certain amount of discretion and management you can use around trade creditors and other liabilities, but the day you can't pay your staff is when effectively you're out of business. Can the charity remain solvent through the period of public health restrictions and beyond? And this is where there's a lot of uncertainty, and it's very difficult for some organisations to forecast what the impact of the ongoing pandemic is going to be on their organisation. You know, how long are the lockdown restrictions going to last? That the furlough scheme's been extended through to March next year is maybe a bit of an indication of how long we might be in these sorts of situations. Things that you need to consider is what available reserves you have. Just remember they're not cash, and what your bank facilities are, and what available support there is from related organisations and stakeholders. So quite often people have umbrella charities that might be willing to give support. Quite often there are long-standing foundations that support certain charities that have been very generous historically, and quite often they will support charities through difficult times. So where else can you look for support? There is government support available, some very industry specific in terms of certain types of charity, but certainly the BIBLs and SIBLs loans are available to charities, and furlough, I'm sure many people have claimed furlough grant. Do be aware that furlough is a grant that you can keep, but if you access those loans, it is a loan and it will need to be repayable. You need to think about the end of furlough and what will happen then. Will you make furloughed employees redundant? How will those redundancies be funded? So it is a matter of keeping that under constant review. Scenario planning and sensitivity analysis. So if we think back 12 months before we were in this almost permanently uncertain situation, what people would do with their forecasts is, this is my best guess of what the future will look like, and there would be a forecast. So now with scenario planning, you might have a number of different scenarios that could be your forecast. So say you're a theatre, it might be we can reopen on the 1st of January with social distancing. We can reopen on the 1st of April with almost normal audiences. You know, we don't open till the 1st of July. There might be various different scenarios that will give you very different financial outcomes that you need to model in terms of what is going to be the most likely outcome. If you can get to a baseline forecast that you're reasonably happy with, you can run sensitivity analysis around that baseline. So the two things are similar but different in terms of scenario planning and sensitivity analysis, but it is useful to look at that in terms of what you think the main uncertainties are. Once you've done your forecast, you need to keep them under review. Certainly some of the finance professionals I've been dealing with, clients feel that they spend all their life forecasting at the minute, and as soon as they finish one, it's wrong. So they then have to start on another one because something's changed. So you do need to keep the forecast constantly under review. So one good example of this would be the job retention bonus. When Rishi Sunak announced that he was extending the furlough scheme, big headline, in the small print, the job retention bonus, which was £1,000 per employee who still had their job in January next year, was withdrawn. So one of my clients had £400,000 for that in their forecasts in January, and then that had to come out. They've put 150,000 back in April, which I think is a little bit ambitious there, because Rishi said it's been temporarily withdrawn, but I don't think he's necessarily minded to reinstate it. So you do need to keep your forecasts under review and make sure that when things change, you are updating them. There is then this concept of reverse stress testing. What breaks your budget stroke forecast? I sit on the board of a housing association, and they call that a perfect storm. So what happens if all the things in your sensitivity analysis happen all at once, and how soon do you break? It's useful to know where that point is. So if you're a membership organisation, it might be membership below a certain level. If you're an independent school, it might be pupil numbers drop to a certain level. If you're reliant upon fundraising, it might be that fundraising drops below a certain level. It's useful to know what breaks your forecast and what will actually tip you over the edge. And then just finally, when you're making the going concern assessment and making decisions about what possible courses of action you can take to allow the charity to continue, you should prioritise your charitable purpose. And we mainly see this in smaller charities, but some people feel their charitable purpose is to keep everybody employed. It's not. You know, your charitable purpose is about prioritising your beneficiaries, and obviously providing services for our beneficiaries involves you employing people, but you may have to let people go in order to allow the charities to survive through a difficult period. So do just make sure you are focusing on your charitable purpose when you're going through going concern and making those difficult decisions. Next slide, please. Just wanted to say a little bit about trading subsidiaries. So quite a lot of charities have trading subsidiaries. It's a tax efficient way of raising money where you have non-primary purpose trading. The trading subsidiary is normally consolidated into the charity, so it's one set of accounts. But for going concern assessment purposes, they are two separate assessments. So you need to make a going concern assessment for the charity, and you may need to make a separate going concern assessment for the trading subsidiary. And certainly I've had a few clients now where we've signed clean in terms of going concern on the charity, but there has been a material uncertainty and an emphasis of matter paragraph for the trading subsidiary. So many trading subsidiaries are struggling. A lot of events have been cancelled, charity shops have had to close, reopen and then close again. So a lot of their income has disappeared. There are quite strict rules in place about a charity supporting a trading subsidiary, and it can only really do so if it's in the charity's best interest to do that. The Charity Commission has issued some guidance on a wide variety of things to do with coronavirus. And within that guidance, about 2/3 of the way down the list, hyperlinked on the slides there is some specific guidance on parent charities offering support to their subsidiaries. And they have relaxed the rules, if you like, on providing that support. But it does say if it's in temporary difficulties, you know, if it's a permanent thing, then again, the same rules apply, that you need to make sure it is in the charity's best interest to continue to support your subsidiary. And just a reminder there that in order to make a corporate gift aid payment, subsidiaries must have distributable reserves. So if your subsidiary has actually made a loss in this year and it has negative reserves, it can't make a corporate gift aid payment. So just a reminder on that point. Next slide, please. Something that we're recommending to clients is a going concern paper for the board. It's quite a good idea to pull together all the information from different sources. It's usually relatively short, just a couple of pages of A4. You could make it a 50-page document if you put all the information from all the other sources in one paper, but I'm not sure how helpful that would be. So the trustees should have had budgets and forecasts. They should have had contract information, fundraising information in other papers throughout the year. If you'd have to make difficult decisions about cost cutting, then you will have had that meeting and made those decisions already. So I think it is just about reminding everybody what they already know, what information there is, what the future looks like. Cash flow is very important in this paper, and it should be forecast together with budgeted profitability. So sometimes we're just seeing budgets. It's not profit that make you have difficulty around going concern, it's cash flow. So it is very important that cash flow is considered together as part of the budgets and forecasts for the entity. You do need to consider insolvency. Are there times when you are going to have to manage your creditors or defer paying somebody that you should be paying in order to keep within your existing facilities? So if there is pressure on your ability to pay your debts as they fall for you, then that needs to be considered. Hopefully it will remind the board of what they already know, and it should highlight where there are material uncertainties, and hopefully it will allow the board to have a debate and reach a conclusion. And I think just a reminder that the board and trustees are responsible collectively for this decision. Sometimes individual trustees, if they're not a finance person, say, do I have to take part in this? Well, yes, you do, because you're on the board, and equally you're responsible for that decision along with everybody else. So hopefully going concern paper is a good way forward. So just really to conclude on going concern, an entity is a going concern unless the trustees intend to cease activities or have no realistic alternative but to do so. And when they make that assessment, they have to consider at least 12 months, but it's certainly not limited to that period. The trustees' ability to continue as a going concern is highly likely to be an area of emphasis for both boards and auditors. You know, there isn't a single charity organisation that hasn't been impacted by the pandemic. And even where I've got grant giving trusts who maybe don't meet that often and just give grants, you know, in a simplistic term, if you've not got the money coming in, you don't give the grants out. So going concern's not that much of an issue. But grant giving trusts have been impacted. You know, the value of their investments will have fallen off a cliff at the end of March. A lot of companies now aren't paying dividends as freely as they were, so the cash income that they get will be affected. So I think every charity will be affected in some way by the pandemic. And the Financial Reporting Council has said that it thinks it's likely that a lot more companies will have material uncertainties about going concern in the current circumstances. That's as much as I wanted to say formally. I'd be happy to take any questions.
Vicky, just to say, there was a question that popped up while you were talking, so I think it's aimed at you, which is from an anonymous attendee. How closely did the Charities Commission police this, or is this not part of their remit?
The Charity Commission doesn't really have any staff to police anything anymore, I don't think. The Charity Commission is very concerned about fraud. They've done a lot of guidance on fraud and cyber security. The fraud stats for the quarter to June showed an 84% increase in fraud, which is frightening. And the Charity Commission is also very concerned about funding terrorism, that international charities might inadvertently fund terrorism. So they're their main concerns. If we issue a audit report with an emphasis of matter on a charity, then we're required to notify the Charity Commission, and the charity itself should also make that same notification. So I normally say, do you want to do your notification, then I'll do mine, you know, where we have reached that conclusion. So they're not really policing this, but they do require you to let them know if you've got a modified audit report. So you would need to notify, and then your auditor would need to notify as well.
Put up thus far, but as I stated at the start, if anyone's got any questions for Vicky or for me arising out of our talks, then please do email us. Well, all the contact details and stuff should be, I think, apparent there. I think we're both easy. Well, there you are. Details are there. We're easy to find if you Google us anyway. A couple of more questions have appeared. Let's have. Oh no, there's a couple of people thanking us. Well, there you are. Thanks, delightfully received. I'm sure that was all aimed at Vicky, but I'll take some of those thanks as well. So from my point of view, thank you very much for listening to us. It's been a pleasure to present to you. Vicky, any last words?
No, just hopefully that was helpful. You know, I think going concern will continue to be difficult for quite some time yet till we get back to some new sort of normal. But hopefully that's helped people understand sort of what the charity's responsibilities are and how it's viewed by auditors.
Wonderful. Wonderful. All right. Well, that I think then concludes it for today. So thank you very much for your time, and hope to see you on some of our Mills and Reeve or Crowe events, or hopefully more joint events in the future. Been a pleasure. Thank you very much.
Okay, thank you. Bye everyone.